Hello, I'm Sarah Allen and welcome to Fund in Focus. Today, Will Granger is going to take us through the Airlie Small Companies Fund. Will, welcome.
Thanks for having me.
So to begin with, can you give us the quick pitch for the Airlie Small Companies Fund and the case for investing in Aussie small caps right now?
Yeah, I think the case for investing in Aussie small caps, it's always really the same. You're getting the opportunity to buy, some really fantastic high quality businesses that are going to be the leaders of tomorrow and have decades of growth ahead of them. You're also getting exposure to a very deep part of the market. The way we define our investment mandate is anything that's not in the ASX 100 that also has a market cap greater than 50 million. That is a universe of more than 700 securities. So it's a huge, deep part of the market, and the wider that opportunity set, the more chance you have of finding really attractive, high-grade opportunities. And then finally, it's a part of the market that's not as well covered, given how deep and broad it is. So that lack of coverage means there's more opportunity for mispricing of stocks within that universe. So I think therein lies the opportunity in small caps. But on the other side of that, there is a bit of junk in the index. There's a lot of speculative companies in there. So you do need a robust process of sifting through those weeds and finding the high-grade opportunities. And we think we do have a robust process of doing it. I think that is where the Airlie difference comes in. We've got a really disciplined approach of buying high quality businesses at great prices. It's a common sense, practical approach that really means we stick to what we know rather than sticking to the and sort of avoiding the more speculative ideas in the market. As a team, we've been doing this for several years as part of our other funds, and some of those small cap ideas that we've bought in other funds have been some of our best ideas. So, the whole genesis of the fund was about, leveraging that existing capability and giving our clients a focused exposure to that product. And I think, there's plenty of runway and plenty of scope for us to continue finding these great ideas in small caps. So that's the Airlie pitch.
So you've recently hit the 1-year anniversary of the fund. 2023 was a pretty tough year for small caps. Can you share some of your reflections on investing over the past year?
Yeah, the fund got off to a good start. We returned 22% since inception versus the market return of 13%. So we're pleased with the start, but we're also, we're long-term investors. We understand that a year often doesn't mean that much. So, happy with the start to the fund regardless. In terms of some reflections on the year, I do think there are a couple of interesting points worth reflecting on. One that I'd definitely call out is the performance of our retail holdings. So we rewind back to the start of last year, and those retail holdings were actually the fund's worst performer collectively during its first quarter. They were creating a material drag on performance for the fund. Fast forward to today, and collectively they're our strongest performers in the fund. And I think there's a couple of lessons that can be drawn from this. One, I think it highlights the issues with focusing too much on fund managers' short-term performance. Really, we think fund managers should be judged over the medium to long term. Underperforming over the short term, it's always going to happen, and I think a willingness to accept that underperformance is actually a prerequisite for generating outperformance over the long term. We're looking for investors who understand that philosophy and will afford us the latitude to invest for the long term. I think the other interesting lesson worth noting is I think one of the last remaining inefficiencies in the stock market is a time arbitrage. There's plenty of market participants who, out of fear of short-term underperformance, aren't willing to take on certain sectors and companies where the short-term outlook might be a bit cloudy. Often that situation creates a lot of selling in that stock or that sector, and for that reason, those opportunities can actually end up being the best long-term performers. And so we want to position the fund so that we can take advantage of that timing arbitrage. And again, that's about communicating to investors and having investors who understand our philosophy and want to take that long-term view with us.
Can you share how Airlie's 4-factor approach to stock selection works with some examples?
Sure. So at Airlie, when we assess businesses, we look at 4 factors. We assess their financial strength, we assess their business quality, we then assess the management quality, before then coming to a conclusion as to valuation. Now, we don't think you can value a business until you've assessed those first 3 criteria. And it's worth calling out that, we really view financial strength as sort of like the gateway hurdle during this process. It's the one thing we won't compromise on. And that's for the simple fact that, even if you've got the highest quality business with the world's best management and the cheapest valuation, if there are question marks around the balance sheet, then all bets are off. There's no downside protection there. So it's the one thing we won't compromise on. In terms of taking a stock through that lens, to give you a bit of insight, Premier Investments is a company that ticks a lot of those boxes. If we start with financial strength, it's probably got the best balance sheet of the sector. They've got around 25% of their market cap in cash and liquid investments. So very robust fortress-like balance sheet there. In terms of business quality, it's a business that generates really strong cash flows, really attractive incremental returns on capital. The lion's share of the value in that business really comes from Peter Alexander and Smiggle. And you look at those 2 businesses, they're very dominant players within their market niches and generate really attractive returns with great long-term track records. In terms of management quality, you've got Solomon Lew, who presides over the business. He's one of the most successful investors in retail in Australia. He's a fantastic capital allocator. And then finally, in terms of valuation, it's trading on around 16 times. That's a discount to the market for what we think is a far better than market business. So that is a stock that very comfortably fits into all segments of the investment process, and it's why it's a core holding in the fund.
Leads nicely into our next question, which is consumer discretionary is one of the largest weightings in the fund. Why are you finding more opportunities in this sector?
Yeah, I think it comes back to our investment philosophy. We're trying to find great businesses trading at attractive prices, and it's very rare that a great business will trade at an attractive price. There usually has to be some sort of issue with the stock that's causing a short-term pessimistic outlook, and that can either be idiosyncratic to the business or it can be a more pervasive sector-wide pessimism. In terms of the consumer discretionary and in particular the retail holdings, which are the majority of that sector weighting, those stocks were severely sold off on the back of fears of a downturn in consumer spending. So it was a sector-wide pessimism. And we took that opportunity to go and buy some really high-quality businesses within that sector at prices we thought were really attractive. To be clear, our theses for these stocks wasn't predicated on any special insight into the macro, any insight into the longevity or the severity of the downturn in consumer spending, but rather an insight into the resilience of their business models, their fortress-like balance sheets, their fantastic owner-managed leadership, all of which would allow those businesses not only to endure even the worst downturn in consumer spending, but actually emerge out the other side in a stronger competitive position. Those retailers have since had a pretty strong run, but nevertheless, given how cheap their starting point was, we still see some material value there, and we remain long-term holders.
Are you holding more or less cash in the portfolio at the moment? What would lead you to change that?
I think there's a couple points I'd make on our cash weighting. For one, we're not trying to time markets. We're really bottom-up stock pickers. So our cash weighting never reflects any sort of opinion on trying to time markets and valuation in markets. And two, I'd say that our focus and goal for the fund is to provide our investors with exposure to some really high quality ASX small caps. And so the fund is designed to ensure that it's mostly fully invested throughout its life. So there is a maximum cash weighting of 10% there. We're currently sitting up pretty close to that 10% mark, and that hasn't changed materially in recent periods, but we're sitting there waiting to deploy capital into whatever compelling risk reward opportunity we find next.
How can investors use this fund as part of their strategy?
Yeah, well, I think the average Australian investor, they're full to the gills with Aussie large caps. They've owned CBA, BHP, Woolies, Wesfarmers for several years, and don't get me wrong, they've been great performers. But I think a good small cap manager can give you exposure to some really high quality companies that you've never heard of, that are just at the start of their sort of growth profile. But the issue with small caps is that if you actually look at the index, there's a lot of junk in there, and it's not a great performer. If you actually compare the Small Ordinaries Accumulation Index to the ASX 100, it's actually materially underperformed it over time. Again, because there's a lot of junk in that index. So if you do want to invest in the space, you really need to find a good active manager who can sift through the weeds for you and avoid the speculative junk and find some really high quality opportunities.
Well, thank you so much for taking us through the Airlie Small Companies Fund today, Will.
Thanks for having me.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.